Hi, everyone. I'm trying out my new headset again. Let me know if you have any issues hearing me. Cool, thanks, Candace. You guys should see an Excel file in front of you. Second here, let's see. Okay, I think I'm going to get started. You can still hear me okay, Candace?
Yeah, we're good.
Okay, cool, thanks.
You're welcome.
Okay, I keep hearing the clicking in my ear. That's what I'm not sure if it's people trying to come in or what. And this is new, so I don't know. But anyway, so if any time it starts getting messed up, just let me know. Okay, so I am going to, actually, I'm just going to get off this thing. It's driving me crazy. Let me go on to my other headset. Go onto my regular computer. Oh, that's why. Wait 1 second. That's all fricked up. Sorry. Let me go on there and then make my headset. Come on. Okay. I don't know what's going on with this. Still hear me okay? Okay, so what we were talking about last Thursday, getting back into chapters 3, the little part of chapter 3, a little part of chapter 4. It's basically the ratios for the project and the horizontal and vertical analysis for the project. So I wanted to wrap up talking about that today and going over whatever ratios that we still need to look at and things like that. So before we get started, Candace, do you have any questions?
No, I'm okay.
Okay, cool. All right. So I'm kind of go back and forth here, share things like that. So if at any time you're not seeing something, just let me know. So I'm going to go into a Word document and just find one. I had one open. Do some notes here. And a Word document. So, screen. No, I don't want to stop recording. All right. So we started talking about the various types of ratios and tools used for financial analysis. And I said I wanted to come back and take a look at horizontal and vertical analysis before we finish up the rest of the ratios we didn't get to cover the last time we met. So the first one I want to look at is horizontal analysis. And there was a file within the folder in Blackboard with just a sample. I'm not sure if we have an income statement or a balance sheet there. But horizontal analysis is traditionally done on your balance sheet and the income statement. Now, what does horizontal analysis tell us? Well, it essentially provides how a particular item changes percentage-wise from another point in time. So we could see, using horizontal analysis, how much an asset or liability or any part of the income on our income statement or expenses changed percentage-wise from last year to this year, from 2 years ago to this year, from 3 years ago to this year. So you could calculate it from any point in time. We're just going to focus on, for our project, from last year to this year. Now, what people will do is they'll do this kind of horizontal analysis to create a trend analysis of an item. What kind of trend does it follow? What kind of percentage change does it go, even from 1 year to the next, or from one point in time to the following year, that point in time, 2 years out, 3 years out, etc. So it's just helping to develop a pattern to see what is happening relationship-wise, what's happening with this item over the years. So the calculation is pretty straightforward. It's the newest balance of the particular item minus the balance at the point in time, whether it be last year or 5 years ago, whatever that point in time, that historical number is, it's the older number. And then you divide that difference by the balance of the item at that point in time. And that's, for lack of a better way to describe it, that's how I'm describing it. So we're always checking to see. We compare the newest to some old point in time. And that will calculate how that item changed percentage-wise from that point in time to the present. So that's what we're accomplishing here. So I'm going to stop sharing and go ahead over into the worksheet. And this was the balance sheet. So to demonstrate it, we're going to be calculating horizontal analysis figures for the balance sheet of Smart Touch Learning. So we're going to take, I'm just going to use dollar numbers or dollars here, the numbers instead of the cell reference. The 29,000 minus the 32,000, because that's how much it changed. Sorry. Let's do it the easy way, Lori. Plus 29,000 minus 32,000. So new number minus that old point in time. So it decreased 3,000 dollar-wise. What's the percentage change? Well, minus 3,000, the dollar change, divided by the $32,000. And I'm going to have to fix this because that's incorrect. I'm not sure how to format this the best, so just bear with me a second. It's out of whack. 0.09%. Should be 9%. I'm just going to get rid of the percentages. There we go. So if we take the 3,000 divided by the 32,000, we will get 9.375%. So it changed by 9%, almost 10%. And that should be a negative, by the way, put the numbers in wrong. So it decreased. Accounts receivable, same thing. Take the 114,000 minus the 85,000, get the dollar change. So that increased. Take the, take the dollar change, positive or negative. So positive 29,000 divided by that older point in time year, 85,000, and you get 34.12%. Positive, so it increased from the beginning of the year to the end of the year by 34%. Same thing with inventory. The new year, new balance minus that older point in time, have a $2,000 increase divided by that older value. So we get a 1.8% increase. So I'm just going to finish this off, and I'm going to use formulas. So I'm going to get my dollar change by taking B9 minus C9, if you're using Excel. And then I'll get my percentage change by taking D9 divided by C9. There we go. Yay, now it worked. And then I'm just going to copy and paste that all the way down. So if you want the exercise of calculating each one of these, you'll have the answer key out there. If you're using Excel, like I said, you could very easily make the calculation by inserting formulas, referencing the cells you want to add, subtract, and divide. Let me just make sure all my cells are formatted properly here. So take D10, I don't even need to do that, I will. D10 divided by C10, and then I'm going to copy and paste that all the way down. Very quickly get our percentage changes. Now these are in decimal format, so you could reformat the cells to be percentages, or you could enter them yourself. See if I can get that accomplished. There we go. Okay, so it very quickly provides us that change. So what do we use this for? Well, we're going to see, first of all, what did we expect? But the decision maker out there, they're going to compare this, the company's percentage change in assets, particular assets, and liabilities, and even equity to the competition. And in the project, you're going to have to pick out, I forget how many it is, but 2, 3, 4 items that really stick out, that are either you're doing a lot better than the competition or a lot worse. And if you don't have any of those, maybe you pick 2 or 3 of them, 4 of them that you're like, yeah, we're pretty much on course with what our competition is doing. But that's what it's telling us, how these particular item changes percentage-wise, so that we have easier comparison to others in our industry. Now we could do this, and it's probably, not probably, but it is a great tool for income statement changes. So when we want to see how did sales increase or revenues or decrease from one year to the other percentage-wise, and then comparing that, our analysis, to our competition's analysis. So this is the stuff you will be looking at within your paper to find these items that are maybe extreme for your company, or maybe you're pretty much in line, but you're doing the analysis to prove that, and then you want to talk about it. Do you have any questions on that? Okay, So that's the one type of analysis. Now the other analysis is vertical. And with vertical analysis, we are calculating the percentage each item is of some 100% item for a year. Again, that's what it is, but it is done on the balance sheet and the income statement. But it's done vertically, up and down on the financial statement, where we just did horizontal going across. It's a per item change. Here we're looking at what each item is percentage-wise of some 100% item. On the income statement, the 100% item is net sales. So it's defined. On the balance sheet, the 100% item is total sales, or total assets, I'm sorry, total assets. So your calculation is always the individual item balance divided by either net sales or total assets, depending on which financial statement you're completing the vertical analysis for. So I believe we have an income statement to demonstrate that from our example, but that's what we're doing here. So it's 1 year at a time. You do vertical analysis for 1 year. Then you do the vertical analysis for another year, because you're basing everything within the current year. What percentage is the current year expenses of the total net sales? So I'm going to stop sharing that and go ahead over back to our Excel. Let me get in there. I don't know if it's going to, hopefully, make sure you can see this. Sometimes when I flip around, it doesn't acknowledge it. Okay, so you should see the income statement for Smart Touch here. And if you downloaded it, you have that as well. But what we're essentially doing then is, you can see up in my formula screen here, I took net sales divided by net sales, which will be your 100% number then. So then we're going to take each item, cost of goods sold, divided by net sales. And I've got to fix these. I hate these formatting issues that pop up. So, time, 513,000 divided by 858,000, 59.79%. So now I'm going to put it in percentage. Take your gross profit, 345,000, divided by net sales, 858,000. So you can see just from these 2 or 3 calculations, sales are 100%, cost of goods sold, so the cost of the items to make the sales were about 60% of the total sales. So if sales are 1,000, we had to pay $600 for the items. So it's giving us a percentage though, because then percentage-wise, it's easier for us to compare to others in our industry or even to our numbers last year. So our gross profit, what percentage of the sales do we keep after paying for our inventory, is at 40%. Do the same thing with all the other items. So I could do this with the formula in Excel, B9. I'm going to cite the individual item. Now, here I want my denominator always to be net sales. So in Excel, we use dollar signs to fix a cell in our formula. So I'm going to use $B, $5. And that will remain constant. It won't keep updating when I drag that formula. So when I do that, now you can see I'm going to go in click and drag down so it copies it all. But take a look. My B5 remains constant where my item in my numerator changes. So B9 it goes to, but B5 stays constant. So that's how you can do that if you weren't aware of it with a formula. I'm just going to select those all, make them percentages, and very quickly now I can see what percentage my selling expenses are of my sales, what percentage my administrative expenses are of sales, what percentage of operating income I maintain in the company, and then net income. There's our profit margin. What percentage of net income remains in, what percentage of sales remains as net income after all the expenses and other items are accounted for. So it tells us a lot about what's happening within the year. But like I said, if we can't compare it to something else, we really don't know if it's good or bad. So I'm just going to very quickly put the formulas in here to calculate plus D5 divided by $D, $5. And that'll give me my 100%. And then I'm going to copy and paste those down for 2017. Make those percentages, and there we go. So now we have another point in time to compare to. Okay, so if we just compare last year to this year, we're doing much better with how much gross profit we're maintaining in the company. Last year, we were only keeping 36.61. This year, 40.21. Last year, we had almost 30% of our sales of our sales were for operating expenses. This year, they're around 28.5. Last year, our profit margin was only at 3.24. That's the percentage sales we kept as net income. Now it's at almost 5.5. So now it could, we might be able to say here, oh, we're improving. We're doing stuff better. The changes we made are effective. Now, from your standpoint, as an independent observer analyzing the financial statements, you're going to pick these kind of things out and maybe say, oh, looks like they made some changes in how much maybe they pay for their inventory, or maybe they're charging more because they're keeping more as gross profit than they did last year. You'll also do the vertical analysis for a competitor and compare to them. Again, picking out extreme changes or extreme differences. Those are the things you really want to try to talk about or try to explain a little bit or point out. And things, maybe if your company's in line with last year and your competitors, you want to talk about that. Hey, we seem to be doing pretty much, here are some numbers. Our cost of goods sold is at 60%. Our competitors is as well. So you want to pick a few items out still and talk about them. But if you have things that are really different than your competitor, either good or bad, you want to talk about those. So you do this analysis again on the income statement and on the balance sheet. Now I'm going to go back over. I'm just going to, I want to show you the balance sheet quick. Let me open up a new page. Make sure you can see this. Okay. Now, I just copied and pasted the balance sheet that we used for the horizontal analysis. How you do the vertical analysis on a balance sheet, you take each item divided by total assets. So I'm going to take cash, 29,000, divided by all my assets, 787. So cash is about 3.69% of all the assets. I do that for accounts receivable. So for each asset, we do that. So now I'm going to put this in as a formula. Plus B5 divided by, I want to keep my B10 constant. So I put that in with those dollar signs there. And it will calculate each one. So now you can see current assets are 33.33% of all assets. Property, plant, and equipment are about 65%. And we have a little bit in long-term investments. So percentage-wise, it's giving us our asset breakdown. We want to compare that to what was our asset breakdown last year? What does our competition do? And maybe make some assessments on that. You know, wow, we have a lot in inventory percentage-wise compared to our industry. Maybe if theirs is at 5%, you want to go, wow, you know, this company keeps a lot in inventory. And think about inventory a little bit. You know, is it smart to keep a lot in inventory? It's an asset that unless you're selling it, it's not making any money. So maybe they're better at managing their inventory than we are, because they could sell theirs out and not keep a lot in stock and still make the sales. So it's like analysis. You're thinking about what impact these percentages have, or what impact on your company, on the company you're looking at because of these percentages. What's the story it's telling? Now, we do the same thing with liabilities and equity, but you can look at it as, this used to freak me out a little bit when I was learning this. I'm like, why do I care about percentage? Accounts payable is this percentage of assets. Well, it's not even an asset. Well, the more you think about it though, so you do C14, you take your total liability or your accounts payable here, divided by, whoops, not C14, B14, divided by your total asset amount. Okay, and it's telling you what percentage each item is of total assets. Now you can look at this from a couple different perspectives. And I look at it from two different ones. Of all the assets, 10% we still owe in accounts payable. Of all the assets overall, we owe on 55% of them. And it's just telling you the percent of the assets you still owe on and the percent of the assets that the owners own of the company. So that's one way. Or you can look at it from the perspective of all the liabilities and equity, 55% are liabilities, 45% are equity. Because if you really think about it, that's what you're dividing by. Total assets are total liabilities and equity. So either way of looking at it is correct. But you want to see, what was our percentages last year? What does our competition look like? Find those things that are different and explain, geez, like for instance, if the industries is a 30% here and a 70% here, they don't have as much debt as you do. So you're in a more insolvent position because you've got to pay this debt off. You've got to pay the interest. Where your competition doesn't have that. They're more flexible. They have some debt, but not to the degree you do. So you're more what we call insolvent because you have so much more debt. So that's stuff like that you want to look for and point out and talk about a little bit. Any questions on that? Okay, I'm going to go ahead back then. I'm trying to think where I was doing this from. I think it might have been Excel. Okay, what I'm going to do, I think, is come back to Word, and I want to talk about a few more of the ratios that are covered in those chapters in 3 and 4, but also are important for this project. So I looked at the current ratio, quick ratio, inventory turnover, day sales and inventory, accounts receivables, turnover, day sales and receivables, debt to equity ratio, and times interest earned. So The main ratios I still want to take a look at with you are the profitability ratios and then the investment ratios. So we've got, let me just copy and paste the ones I want to do. Bring them over. And I have the pages that the different ones are on. Make sure you can see this. Okay. So the profit margin ratio, I already talked about it. And I pointed it out to you when we did our vertical analysis. So our profit, by the way, these do have the title profitability. That's what we're measuring here. Profit margin is found by taking net income divided by net sales. And if we were looking at the company we just did our vertical analysis on, okay, when we take their net income divided by net sales, I think it was like 5.5%. And that's just telling us the percent of sales the company maintains or keeps for the owners. Now remember, this income could remain in the company or I should say, be paid as a dividend to the stockholders. So a company may pay all of it as a dividend, pay none of it as a dividend, or pay a portion of it as a dividend. But it's measuring how well the company manages their expenses, manages their revenue. The efficiency component comes in. And really, this ratio does not mean anything until you compare it to others in your industry and even to your prior self, because I've worked in different industries, in trucking, in transportation. I was jumping up and down if this was 8%. In broadcasting, I was jumping up and down if it was 30%, okay? If it was at 8%, I got a lot of trouble in broadcasting. It should be at least 30% in that industry. So it all depends. So I can't sit here and go, oh, that's a really good ratio. I don't know. We're just showing you the calculation, what it means. And now it's going to be up to you to take that, compare it, and then say, okay, at least to my competition, to myself from the past, here's what I'm looking at. But that is just measuring how well the company makes a profit by measuring how much they maintain of their sales. The gross profit margin, now you're only going to have this if your company sells inventory. If it's a service company, you're not going to have it, of course. But that is your gross margin, remember, which is sales minus cost of goods sold divided by your net sales. So now where gross profit margin looks at all of income, gross profit margin is looking at your income from just selling your product. So the percentage of sales left after paying for the product you had to sell, the product costs you sold, because it is sales minus cost of goods sold. Sales, what you charge the customer, cost of goods sold being what you paid for the item you sold. So pure profit after selling your product. Compare that to others. Remember, you still need to subtract expenses from it, but that's what it's telling us. Any questions? Dookie? Rate of return. I'm going to grab my book. Sorry, 1 second. Okay, a rate of return on total assets. I just want to make sure. Sometimes authors do things a little differently, and I do things a little differently than authors. I get people jazzed up. just because sometimes there's different ways to compute the ratios. Oh, okay. Let's see. Okay. The first one, return on total assets. I do it just a little bit differently because I like to include interest expense in the numerator, but your author doesn't, so this is the way we're going to do it. Rate of return on total assets. The way you could think of this is you have a savings account. Okay, so let's say you have a savings account. The savings account is comprised of a couple different components, just like any investment is. The investment or deposit you make. So let's say you make $1,000 deposit. The next is your rate of return, which is your interest rate. Okay, so say it's 5%. Then you get your return on investment, which is 1,000 times the 5% or $50, right? Any investment, these three components can be calculated if you know two of the other ones. For instance, with your savings account, you know the investment amount, and the bank tells you your rate of return. You're going to get 5% interest. So you can calculate the return you actually make, the money you make on the investment. What this is doing is telling the rate of return on the investments in the assets. Now, how do we achieve that? Well, what is the return on assets? What is the return on investment of assets? It's net income. It's how much money the company made. The investment in a savings account makes $50 of income. The investment of money in assets makes net income. We divide that by our average total assets, the investment. Okay, so because when you invest in assets, we're going to talk more about where does this money come from, this average total assets? Who are we calculating this for? Because you know that, you got the money, you know how much your assets are. But the company can't say, we're going to have a 5% rate of return. No, they make the money and then they calculate how much the actual return was. So we know the $50 and the $1,000 going into this from our example here. And we're trying to figure out the 5% or that rate of return. In our real life, we usually know the investment and the rate of return. And we can calculate that before making the investment. With companies, it's a little different. So that's what it is. Now, why do we need it? Who cares, right? Well, remember what total assets are. Assets equal liabilities plus equity. So where does the money come from to get the assets? These two groups, creditors and owners. Now, as a company, we want to know how well are we using the assets, the money given to us, to make a profit, the return on investment. But these two groups want to know as well, because it's their money that was given for those assets. So if you have a company who's, I'm just going to give a scenario here, net income, of course, would be taken right off of your income statement. is $50,000, and assets, total assets, remember you're using, at the beginning of the year are 700,000, and total assets, whoops, at the end of the year, sorry, are 750,000. We would take the net income of the company divided by, remember, average total assets. So you want to take the beginning of the year plus the end of the year. The average would be divided by 2. So 50,000 divided by 725,000. So the average amount of investment assets were 725,000. They were used, made a $50,000 profit. So if you take the 50,000 divided by 725, that's a 6.9% rate of return. That's like saying, if you took that money and put it in a savings account, it would have earned 6.9% interest. That's the type of investment vehicle this company is. So that's why it's important, because people want to know, how well are you using that investment? I want you to make an 8% return on my money. They're not doing that. Okay, so the higher the return for a company's assets, the better and more efficient use of the assets, because they're producing more in income for every dollar of investment. Do you have any questions on that? Again, how well the company uses the assets to produce net income or return on investment. That's why it's important. It tells us how profitable we are. And are we reaching our goals? Are we doing what our competition is doing? Because they're going to look better than us if we're not. The final profitability ratio just focuses on common stockholders' equity. So now we're doing another rate of return, but it's not for all the assets, all of the investment, but just the common stockholders' equity. So just the money given to us by common stockholders. This all investors. Again, the numerator, now your book calls it return on equity. And return on equity would be for all stockholders. I focus on common stockholders because I want you to remember that. When we do a rate of return on common stockholders' equity, okay, if there's preferred stockholders, their rate of return is going to be different than the rate of return on all equity. So if you don't have preferred stockholders, the rate of return on equity and the rate of return on common stockholders' equity is the same. There's no preferred stockholders. But I like to do this separate just in case there are, because the first thing we have to do is determine what is the return on investment? What is this amount that should be in our numerator for a common stockholder? What are we making for them? Net income we make for all the stockholders. But if we have preferred stockholders, we subtract out the part of net income that's already promised to them, their dividends. So that part of net income will never be given to common stockholders. It's not made for them. That part of net income is made for the preferred stockholders. So now we just have isolated the part of net income, the profit that was made for the common stockholders. We divide that by our average common stockholders' equity. Now, I do this because what's important is if you have common and preferred stockholders, common stockholders' equity will be your common stock plus additional paid in capital common stock plus retained earnings. So you would include all of those items in your denominators. So I'm just going to say the common stockholders' equity for this company at the beginning of the year was $350,000, and the end of the year was $400,000. And the preferred, let's pretend there's preferred dividends, are $5,000. Taking the information from above, the net income was 50, so I'll do that again. Now, fill it in. 50,000 minus 5,000. So of the 50,000 in net income, only 45,000 is available or made for the common stockholders. Divide that by your average common stockholders' equity, which would be the beginning balance plus the ending balance, divided by 2. So we're looking at 45,000 divided by 375,000. And getting 12%. So although the overall return to everybody, return on assets of all the money given for assets is like 7%. The part of the money that is given from the common stockholders for the assets, they're getting a return of 12%. So they're using their money, and from an investor's perspective, they're saying, I want that ratio to be at a certain level. So the company wants to get that and wants that to be as high as possible because it helps their stock prices. So if they're not in line with what their competitors are doing or even what they were doing the prior year, they need to work on that because their stock price will be affected by it. But that's what basically it's telling us. How well the company uses the money from the common stockholders to produce net income or a profit. Any questions? Okay. So the next ratio you've probably seen, it's one of the most well-known ratios, and it's quoted quite a bit. It's so important. As you saw in Intermediate Accounting 1, we include it directly on the income statement. So usually we don't have to calculate it, it's there. And that's earnings per share. Now, in 2 chapters, I think it is, I think we get into earnings per share is a complex calculation, but we're going to keep it simple here because the denominator could get more complex with calculating to calculate that, and that's where it gets kind of funky. Generally, you take net income minus preferred dividends, and you divide it by your average outstanding common stock. So you take all the net income of the company, now subtract out the part that's already promised to preferred dividends for preferred shareholders. Because earnings per share tells us the amount of earnings, net income, per share of common stock outstanding. So if you have preferred stock sold, you have to make sure you subtract out any preferred dividends that are promised for the year, whether they're paid or not, because that part of net income is not available and has not been made for the common stockholder. We divide that by the average outstanding common stock. Now that could get to be a complex calculation. For now, we just look at it as the outstanding stock of the company for the year. So remember, there's authorized, that's how many could sell of stock, issued, how many have actually been sold, but outstanding stock is the number that have been sold minus any treasury stock, any stock the company repurchased of itself. And why do we use outstanding? Because these are the ones that get dividends payments. And investors react significantly to a change in earnings per share. I like to look at this computation as if net income was all declared as a dividend, that's the maximum dividend you would get this year for each share of stock. So you can look at it from that perspective, and investors will make decisions based on that. So if we go back to our example, we have net income was 50. Preferred dividends, PD, were 5. And let's say the average common stock outstanding are, 30,000 shares. We just fit that into our formula. The 50,000 minus the 5,000 for those preferred dividends, take those out. Only $45,000 of the net income has been earned for the common stockholders. So now divide it by the number of outstanding shares. Should be $1.50. That equals $1.50. So the amount of profits or earnings for one share of common stock that is outstanding that could receive a dividend is $1.50. Compare that to last year, compare that to others in the market, in your industry, your market. Like I said, you won't have to calculate this for your project. It will be given, it'll be given for your competitor, but you want to take and look and analyze and see how well your company is doing to that other company you pick to compare it to. The last ratio is called the price earnings ratio, and it's actually not in your book, but I like to talk about it because it's another ratio used by investors. And it's cited a lot in finance all the time. They call it the PE ratio. It's found by taking the market value of the stock. So on the day of the balance sheet, would find the market value of the stock, one share of stock, and divide it by your earnings per share, EPS, earnings per share. The official definition is this. It's the value, the market, those people who are buying and selling your stock, place on $1 of earnings per share. So it's the value they place on $1 of earnings per share. Yeah, that means a lot too, right? So let's take a look. Let's say your market value of your stock, the day you calculated earnings per share, is $10 per share. Let's make it 50. Well, the calculation here would be the $15 divided by that $1.50 we calculated in earnings per share, or $10. Now, so you're like, okay, the market places a $10 value on $1 of our earnings per share. Yeah, well, let's put this in perspective. And usually when I do this next example, people could tell me the first part, but they can't tell me the second part. So let's say last year, or a couple weeks ago, not even last year, a couple weeks ago, our company came out and said, we expect our earnings per share to be $2.50. The buyers and sellers of stock, the market, are going to react to that. They're either going to react, positively or negatively, whatever the case, but they react. So the price will go up or down based on their reaction. Okay. But now it's April 14th, and we announce earnings per share is really at $1.50. The market is going to react. Now, how will it react? Usually people will say, will the price go up or down? Well, it's going to go down. You expected $2.50, you came in at $1.50. So price will go down. Then I say, how much? And they go, $1? No. Theoretically. So according to this theory, $10. So you can see how much that $1 difference in earnings per share affects your stock price because of the value stockholders put on it. If price earnings ratio is $10 or 10, the price should go down by $10 if this earnings per share decreased by $1. Now, if it decreased by 50 cents, it should go down $5. But it gives us an indicator of the value placed on that earnings per share amount from our company and how our stock price will be affected. And investors know that too from this computation. Okay. So again, you want to take a look at your competition, calculate their price earnings ratio, and do some comparisons and discussions. Do you have any questions on that?
Nope, all good. I remember a lot of it from last time.
Excellent.
Thank God.
Excellent. Cool.
Thank you.
Yeah, you bet. That's all the ratios that you're responsible for, and I wanted to get through that horizontal and vertical analysis. So, do you think you're set for your paper?
Yeah, I think I'm pretty good. I have I actually have a template still put together from the last one, so I'm gonna work off that to help me.
Awesome. Awesome.
Thank
Okay,
you.
cool. You bet. Well then, let me see what I got going on here. Set everybody up here who isn't even here. So we're all good. Spring. I saved it in the wrong place. So I knew you were asking about that chapter 3, chapter 4 ratio thing, and I hope you saw my announcement. We're just going to make, basically done with that. Maybe we'll come back on the 16th. I'm gonna, let me see something very quickly. Because I have half stuff one place, half stuff another place. Let me just check on this. Spring assignments. Oh, geez, just open. There we go. Okay, yeah, I don't have any practice problems to review for Thursday. I think I'm going to probably start looking at the next chapter Thursday, or maybe we'll give everybody. Bear with me a second, Candace.
Okay.
Lecture 6. Maybe I'll give everybody Thursday then to just get ready and get that test completed on chapters 12 and this 3 and 4 ratios. Okay, and then the problems all done in that. So
are we gonna have class on Thursday?
no, I'll just give that
Okay.
as the day to take the test, and then we'll just
Okay.
meet next Tuesday for start our lecture on chapter 6, and then you guys can get working on your ratios for your project. You'll have some downtime to do that.
The ratios that due for our project, is that due on the 20th, Monday?
Not for the project. I think it's the 23rd.
Oh, okay, even better. All right.
Yeah, I'm pretty sure I have that one out till the 23rd. Just to give me enough time to look at them, give you some feedback so you could wrap up the entire thing, you know?
Okay, sounds good.
Yeah, so I think we're in great shape.
All right, thank you very much.
All right, I'll see you next Tuesday.
All right, take care.
You too. Bye now.